All right, great. Thank you, everyone, for dialing into this week's Group CIO call. So, John Davi from Astoria Advisors. Happy to have Darren Hinsaw from NB Securities and Neil. How do you say your last name, Neil?
Jesus, Azous.
AZ. Okay. Um, Neil from Rare View Capital. Neil and I were at the ETF conference last week in Las Vegas. That was a lot of fun. Um, and Darren joins us from Orlando. So typically this is a casual conversation. We allow advisors to kind of join in. I find this useful. I kind of grew up on Wall Street trading floors where, you'd have people from credit, FX, rates, equities, derivatives, like all coming together. We talked to a lot of different portfolio managers, traders from buy side firms. And I just find in this world that I live in now, it's kind of nice to have groups of risk takers kind of thinking about market. So we'll start with tariffs. I'm surprised that the market is reacting the way it is. It feels like it's more draconian in nature. Trump has been saying that he would lean hard on tariffs. I told Neil earlier today when we did our pre-call that, I'm just shocked because, Besant was on TV saying we're going to go into a detox period. Trump was on Maria's show saying it's okay if we go into recession. They did warn you, right? Besant had his 3% plan or whatever he calls it, where he said that he wanted the 10-year to be at 3%. So I feel like it's kind of shame on you if you haven't prepared for this. Um, we'll start with you, Darren. So how are you reacting to tariffs? If you want to clarify,
Yeah.
what you just told Neil and I, that'd be great.
So first of all, one of the things we've been talking even before everything that occurred yesterday is, there's kind of there's right now there's headlines and data that's going all over the place, or headlines and sentiment versus data, and the headlines have been, fairly exaggerated, I guess I would say. But if you've looked at the data, at least so far, a lot of even the unemployment numbers that came in today was 219,000. Those are still historically low. So economy has started off good. At least looks like it's still going good. And on tariffs, I think what a lot of people were hoping for is clarity. I do think that the market was a little surprised on the extent and size of them. And one of the things we've been saying, and we've tried to put some math to it. So essentially, we think it's 10% across the board, with the exception of Russia, Canada, and Mexico, starting tomorrow. And then there's 25% additional tariffs on the 9th. Most numbers we've looked at is probably anywhere from 25 to 35%. And then what we're saying is do the numbers. Roughly we bring in about 3 trillion in imports, take Mexico and Canada, which are our largest trading partners, out. That's about $1 trillion. You put, I don't know, kind of call it a 25% on 2 trillion. You're at about $500 billion. So it's probably somewhere between 500 and 800 billion. But that's assuming that everything goes in the way kind of it was described, and we still don't have those exact numbers. So I think one of our assumptions is it won't be that bad, but $500 billion in an economy this size, $500 billion is a lot of money. And Goldman said some stuff, JP Morgan said some stuff today. He said, look, if these numbers continue, look, it's definitely lower growth. Q4 GDP was 2.4, so you certainly aren't expecting that. I don't know, maybe it goes to a half, maybe it goes to 0, and you're probably going to have a higher inflation.
Yeah.
But yeah, John, he's been
Darren,
saying that the whole
yeah,
time.
but Darren, the problem is, Darren, is like you went into this year, like you think about like, 2x levered single stock
Mm-hmm.
ETFs, right?
Mm-hmm.
30, 50 billion went into like, real crazy levered ETFs last year. January ETF flows, January's only 2 months ago, was the largest inflow. Too much money came in late in the cycle, and
Yes.
S&P was a very expensive valuation. So like there has to be like a degrossing period. And Neil, what do you think, Neil? I mean, the question is, we're down
Uh,
10%. What's the probability we go
yeah.
down 15, 20? And then how do you adjust the portfolio around that?
All right. Okay. First, John, thank you for having me. Nice to see you. Darren, nice to be here with you for the first time in our careers. I hope we get to do this again.
And both of you guys, please take all of my words with a grain of salt. And it's meant to be encouraging, not disparaging or anything like that. But with all due respect, I have no idea what anybody is talking about or what all of you or anybody else have just said in the last 15, 20 hours. Here's what I think I know, which is very little. No one I know on Wall Street, and I've been doing this a long time like you guys, has a bat phone to Trump in the Oval Office, including the Secretary of Treasury, who acted like he didn't even know these details, which means the details were really right up to the clock or the last minute before they were put in. So it baffles me that there's a lack of humility on broad Wall Street, where every institution woke up yesterday and said, here's my base case scenario, my best case scenario, and my worst case scenario. And then Trump comes out and he's 3x the worst case scenario. And now we have markets down 4 to 7% around the world in one day. And everyone's now trying to rationalize or count the beans associated with everything. I think we should just take a step back and say, President Trump specializes in chaos theory. He's up 20 out of 24 hours a day. Algorithms and systematic strategies can't keep up with them, let alone human behavior. That's number one. Number two is these are big structural forces that a guy like him has been talking about for 40 years. He did it in his last term. He did it on Oprah in the 1980s, whatever you want to look at. This is the guy's baby. And to think that we're going to have an edge in what he does or thinks, or that we could go to battle with him, meaning stand toe to toe with him, everybody should be crazy. This guy has been in the abyss many times, bankrupt many times, impeached twice. So to think that somebody's coming up with a reciprocal or counterattack to him and he won't take the United States of America to the brink, which we know will total the next 25 countries combined, they should all just stand back and have a high degree of humility regarding this overall discussion. And then to your point, John, I would just about, can this get worse in the equity markets? Well, of course, the answer is yes. And we should know more tomorrow. I'll give you an example of that. The sentiment data or the survey data that all of you have seen and watched, it has been ignored for many years due to the degree of fiscal stimulus as well as the shadow benefits of immigration. Now we're at the extreme in those numbers and it's bleeding into the hard data. If we wake up tomorrow and the employment report is much worse than expected because we're seeing the first impact of Doge and private sector jobs being cut, you should expect something beyond the annual one-time 10% correction and think that we are on the precipice of pricing in something recessionary like that would certainly lead to a bear market, wide number, minus 20 to minus 35%. It's not my call. We just have to see that data and be open-minded to it. So if we wake up tomorrow and jobs are 50,000 and the unemployment rate ticks up 0.2, we'll extrapolate out that we're into the hard data. And then Trump just accelerated that hard yesterday because none of that's even in the data yet. We were going to reprice earnings immediately and we'll be down whatever the average number is. When you go down minus 10, you end up minus 14 on average in the S&P 500. So we should all be open-minded to that, and the vice versa. If the number's good and it allows us to kick it down for another month, we'll play ping pong here at lower prices till clarity evolves with whatever President Trump wants to do. But let's all not act like we can count the numbers. We know what's going to happen tomorrow, and he's going to save us. I mean, he's not, assuming he doesn't run for a third term or make himself a third term, then he doesn't have much to lose here.
Yeah, the problem, I'll say one thing, Darren. The problem is that he kind of warned you, right? He said, like, okay, we're going to get, we want the 10-year to be 3%. We're willing to put the economy into recession. So, when we think about portfolio construction on our side, we went into this year saying, okay, we think the risks are nonlinear. We think that you should own alts, you should own gold, you should own real assets, own things like BTAL, which is doing well on a day like today. It's probably the only thing up in our ETF models. You should not own the Mag 7, rotate. That's kind of why we have like more equally weight. So, we do think that like you should have been appropriately warned. And, now it's like if you're making moves down, let's say 10% on equities, the S&P down 15% for the average, mid cap to small cap stocks. The question I have for you, Darren, is like, is it too late? Like, how much more downside is left?
So I'm going to go back to Neil's point. Forget Trump, look, the reality of it is downside risks on the market generally when I talk to people is 50%. We had it 07, 08, 09. We had it 2000, 2001, and 2002, crash of 87, 25%. So, I mean, to me, really, the number is generally, 50%. So can we go down dramatically more? We certainly can. But I do think one of the things we're also talking about is all the negatives. The numbers I just put out, hey, and you're right, Neil, nobody knows what he's thinking. And quite frankly, most people don't know what anybody's thinking. So things can change pretty dramatically. But what I would say is there's also the reality of, maybe things kind of come back to, and you have good news. I mean, Doug Ford was on, I don't know what, there's so many stuff going on right now. I forget what I was reading him from, but he's the premier in Ontario. And, yesterday, all of a sudden he was like, oh no, there are, the U.S. is our friends, great relationship. Whereas a week ago is, well, the friendship's over. So, and I think that was a result of, hey, we're not going to do this to Canada. So the other thing you ultimately could do, you could all of a sudden have maybe some of this stuff unwinds. It's not as extreme and you get a pop up. John, to your point on what are you doing? Look, we were already balanced at the end of last year. When you have two incredible years like that, if you're not rebalancing, and our safety, by the way, is bonds. And we do individual bonds, AA, we're in munis, we're in corporates, stuff that, you're going to get paid on. That's our safety measure. And the other thing that's happening as well, and I know, John, me and you have spoken about this as well. Look, you can't just be in the S&P 500 and have 7 stocks worth 40% of your portfolio. So equal weighting, like the ROE, which you use, we do equal weighted portfolios as well. We're diversified. And if you're a diversified portfolio, okay, you're down 7.5, I'm showing right now in the S&P 500. I guarantee you our portfolios are not down that much if you're diversified. So we're probably down 2 or 3 for the year. I mean, that's not great, but it's not awful either.
John, can I just share with you guys a screen on that real quick and pick up on that, if I may? So just give me 1 second here and just let me just attach some hard numbers to that because
and while you do that, Neil, I'll just mention that we did the last group CIO call. I had 2 bond guys and they were pretty bullish, and yes. I knew that it was a contrarian indicator because usually bond guys speak like Neil. For those in the audience, Neil's manages the RTRE ETF. It's an actively managed bond ETF. He manages RDFI, another actively managed bond-centric ETF. So Neil is talking how normally bond guys talk, which is bearish, and so I'm happy that we have Neil to contrast the last group set.
Yeah, I appreciate that label. We do manage multi-asset, all sorts of things. So I try to treat all my children the same. But I did start my career in fixed income at Goldman Sachs. But I've become very agnostic to the region, the asset class, or whether something is a cash or derivative instrument. But that said, can you see this screen, guys?
Yes.
Okay. Yep. So all I did was take the closing price last night of blended portfolios as of last night's close on a global basis, and then on the right side, the United States basis. And these are just the numbers. So like the top one would just be global equities, 10%, fixed income 90%, and then so forth. And the beige are the standard 60-40 portfolios. So if you're a guy in our world that focuses on diversified blended portfolios on a global basis, you only have one portfolio that's negative on the year, which is down 27 basis points. Things are not that bad. Your behavior and your emotion should be contained and very rational at the moment. Same in the U.S. Of course, if you were 90% equities, you're down 2.8%. Big deal after being up back-to-back 25% years roughly in the S&P 500. So let's just make sure we get our bearings as to most people who run money in the financial advisor community that use models or financial planning tools have some version of a blended portfolio or a risk-based portfolio that is doing just fine. Now, if you're a professional or you work on TV or any of those other types of things, and you focus on stock picking, style premium like growth versus value, momentum or factors, right? Sector rotation, you're getting slaughtered. You're down 5, 10, 15, 20% year to date. And what that speaks to is what game you're in and what you're playing for. So if you're smart and you think you can pick the right sector rotation or the right factor, good for you. And you can do that over a 5-year period. Outstanding. You should open a business on that because very few people can do that. If you're in a standard blended portfolio, it's business as usual. You shouldn't be impacted. For example, today, yes, the stock market is down today, but so is the bond market. It's making new lows in the interest rate for the year. And for the first time in several years, really 4 years, the bond is actually acting as a ballast in the portfolio or a stabilizer. It's doing what it did for the previous 20 years. And so these things are working. Now, while we're here, I just want to point something out that is observable to me and something that I think is extremely important right now regarding all of these conversations. So we call this the macro unicorn. It's a very rare occurrence that both the S&P 500 and the US dollar is going down at the same time. I've highlighted those on this scatter plot in a red oval down below on the bottom left. The only other times that this has happened is in the beginning of 2008, back in 2002 as we ramped up for the Iraq War, and then in 98, relative to a bunch of different crises that went on at that time, long-term capital, the Asian crisis, etc. If you were around like that like us with some gray hair. My point is that when this occurrence or this can be observed, bad things usually happen. You should pay attention. I don't know exactly what those bad things are or the degree of those bad things, but you should be sleeping with one eye open when the backbone of portfolio construction, the implied correlation between a stock and the US dollar breaks down. You and I and everybody are not smart enough to know what that means, even though there's a small sampling of that. So we pay a lot of respect to that. And just to reiterate that, one other way to show that to you on this slide is just a ratio chart, very simple, of the price of gold to the price of the S&P 500. Gold is not only outperforming the S&P 500, if you go do that against all 11 sectors in the S&P, gold is outperforming all 11 of them. Usually, gold underperforms healthcare or staples or the defensive sectors during these times, but gold is outperforming it. And the same thing, there's just more and more of these observations. I'm not smart enough to know what that means, but when I see the S&P and dollars fall at the same time and gold outperform all 11 sectors, I say to myself, there's something going on in the background. Be mindful, reduce your conviction level around things, go back to some basic things, diversification. If you don't need it, get rid of it in the portfolio. If it gives you a headache, dump it. If you're not smart enough or you got to wait 6 months to be vindicated on it, pitch it. You don't need it, right? Hunker it down. Doesn't mean you're not supposed to be invested. Doesn't mean you're not supposed to collect your income, right? But just get rid of the unnecessary things. And if you don't do it, it's okay. The market's going to do it for you here shortly.
So Neil, I got a question for you on that. And I know, once again, it's a small sample size.
Sure.
Generally, when these things start happening, it tends to, once again, going down, markets down 50%. It's not a 6-month thing. It's a year and a half, 2000, 2001, same thing.
Yeah.
These trends tend to last longer than most people think, right? Everybody thinks the market's instant to instant, but I think it's certainly random in the short term, but in the long run, they tend to be longer cycles. What's your best idea for a cycle? Is it 6 months? Is it 12 months? Or is it,
I by the way, I know lots of people use that cliche, like, thank you very much for that question. That's a good question. It's a smart question. In this case, that's actually true. I appreciate you asking that, Darren, because if you're Donald Trump, you're saying to yourself, I have 1 year since I've been given this mandate to do anything I can and blame it on the previous administration. And then he's going to say, once I fix the ship, we're off to the races with animal spirits in 2026, right? I think if you look at the magnitude of the things underway, pick any alphabet program in the world, WHO, IMF, NATO, whatever it might be, that entire doctrine over the last 75 years is, quote unquote, structurally being turned upside down. nothing happens overnight, and nothing happens in a 1 year time frame when you're ripping apart something over 75 years. You know, Henry Kissinger is probably rolling over in his grave right now, looking what's going on. I would imagine if the United Nations left New York City and wasn't going to go to Shanghai, Trump would have them leave there tomorrow morning, right? If he didn't lose that home court advantage, but he doesn't need them or want them, right? So I think we have to take a step back and respect that structural changes are underway that are moving at lightning speed, and they don't iron themselves out in 6 or 9 month periods, and that we should elongate the cycle. I think secondly, if you said, all right, whatever he's doing, whether it's Doge or tariffs bringing in new revenues to complement our tax receipts to offset our deficit, and we're going to bring down that deficit to GDP ratio that's been running wild. Okay, well, that's great. That's us, but at the end of the day, that's austerity. And if you can't do that in parallel or in a linear way in the time frame that you do with all of those new revenues or tax receipts, well, then you're just going to have lower growth during that period, right? So my answer is I think it takes 2 years, not one, just like COVID took 2 or 3 years to unwind. And I think these are structural, and I think these are real based on the observations we're all seeing right now, and we should respect that. And I think the things that you do, I mean, I can tell you what we've been doing. I'm not going to suggest that they're going to be right for everybody. For those of us who don't know us, we have 3 businesses. We have a traditional wealth management business. We have an outsourced chief investment officer business where we join investment committees, take over the investment management of other RIAs, et cetera. And then we have an ETF suite. We have 5 ETFs, another one coming out in May. And so we're growing that. So in all of those, we are doing 3 things. Anything that gives me a headache, anything that's going to take me months to be vindicated on, just gets pitched or removed immediately. That's easy. Number 2, when I think of this profile, realistically, if Trump's tariffs stick here, everyone, like I said, they modeled in a 0.5% increase in inflation. So if inflation is running at 3.5%, the worst case scenario was we were going to go to 4%. Well, if we got 3 times what the worst case scenario was, you have to assume inflation is going to 4.5%, and we're going to crush growth in this process. So there is some version of stagflation. The only things that work in that environment historically would be infrastructure, some version of inflation protection. John, I know you have a good ETF, PPI. I don't know if I'm able to mention it or promote you, but that's on my doing. That's a good type of product to think about this in this environment. Thirdly, when you think of credit, this is the hardest part because high yield, for example, has been the best performing Sharpe or highest Sharpe ratio trade for the last 25 years. I know everybody likes to poo-poo on it. However, it's really the greatest sector out there over the long term. And so it's very hard to sell it down. But 70% of high yield is credit and 30% interest rate. In these environments, that should hurt high yield a lot. And so you need to have on some version of commodities, liquid alts, private alts, inflation protection, and stagflation type of portfolios.
What about tips?
You know, I always joke because we spent a lot of time on this in our lives. Tips, respectfully, are for the birds. They don't ever do anything that you really.
We don't own any. I was just asking.
Yeah, they're for the birds. You can't get out.
I'm not sure if I understand.
And they don't
what
do
that
what
means,
they're supposed to do when you think they're going to do it. That said, if you're here for 20 years, they do have a pickup historically of 10 or 20 basis points. For all of us, that's a waste of our time. But if you're a big pension fund, sure, that's helpful on your liability against your liabilities. But otherwise, I wouldn't take the extra 10 basis points for the lack of liquidity that comes with that. So I would just keep it simple. Otherwise, like I said, I have to be, when you get down 10% in the stock market, there's 2 decisions. You're buying the dip because it'll just go back to normal, or 2, we start pricing in a recession, which means you're pricing in a correction south of 20% or a bear market. Right. When you're in the middle of that, like we are right now, that's the most difficult time to make these decisions. I think what we're just saying is we've done what we can to batten down the hatches, got rid of around the fat around the edges, and we're mentally prepared that if this goes sour, that we're going down more than minus 20% and we're ready to act. So we have our list of the actions that we need to take and we're prepared to do it. And I think the most important takeaway is not necessarily the actions we're going to take. It's the mindset that we're right now prepared to do that because that's the juncture we're at. And I'm not saying that because I throw bombs for a living or sell blood. I'm trying to be as optimistic as I can about the stock market. But these guys, as John highlighted, Secretary of Treasury and the President of the United States said, it's okay if we're in a recession for a while. We got to get our
I've
ship
just
in order.
never heard that before. I've
No.
never heard the president or the administration say we're willing to put the economy into recession. So that's why I kind of say, like, shame on you if you didn't really act accordingly.
Yeah.
But let me go to Darren for a little bit. So Darren, you and I did a panel together in Florida. Like, what would you specifically say that, like, you would do to kind of react? Let's say if now earnings start coming in, which is going to start very soon, the next week, we can have the banks report. The big tech stocks are like 23%. The big tech stocks, let's say, are in like 2 weeks, 3 weeks. If you're a big corporate, CFO, like, are you really going to like plan for CapEx? Are you really going to like, do hiring? You're probably going to freeze. Like, what would you do if now these earnings start coming in and all of a sudden, like, that was the last saving grace? Because right now we're not in this fundamental market. It's all technical, CTA, momentum. It's, macro driven. And that's what I think what Neil was saying is, like, nobody really has an edge trading macro in our world, let's say.
Agreed.
So, like, what would you do if all of a sudden now, like, the the wheels fall off? What would you do in your portfolio?
Well, first and foremost, we're already kind of the way we purchase equities in our SMA portfolios. We're on quality already. We tend to perform better when the market's down, perform better if the market's okay, and if the market's just ripping along and it's up, 35%. We're not up 35%. We're generally up 30s, which is close enough for government work. The other thing and this gets back to one of the things Neil mentioned, and I think this is, to me, this is a longer term play, and we were talking about it for the last month, and I think that there's going to be an opportunity to do this over time. Austerity, right? 07, 08, 09, Europe's about the same size as we are. They chose austerity. We did not. Most people think we probably should have spent more money coming out of the great financial crisis, which is probably why we spent the 11 trillion or whatever, if you include tax cuts and everything, after COVID, which is probably too much, by the way. It seems to me we're about to do the same thing. So if you just look at the numbers, and I tend to be a basic math guy. This is not differential equations. You take $500 billion in taxes, tariffs, whatever you want to call them. That's taking money out of the U.S. economy. That's austerity. And if you take $800 billion or euros, which they're talking about over in Europe, and you start pumping that into the military, which ultimately goes to the rest of Europe, one of the things we're starting to do is move a little more towards international and specifically to Europe. So if you wanted to make it easy, it's an EFA play, something like that. And I just think that it very well may be that we're undoing what happened after the great financial crisis. U.S. and international tend to be longer cycles. So the 90s was great U.S. After that, Europe did better if you had a higher concentration in Europe. And then we've done so well up until, literally this thing started to kind of fall apart. And right now Europe's doing a lot better. So I think there's a trade there. The only thing I would, I come from a background of also talking to clients, and I have my own clients as well. The one thing I would caution people: don't get too institutional, where you say the U.S. is half, the world market cap's half U.S. and half international. Remember, your clients still live and spend in U.S. dollars. So if you get it wrong, right, then you're going to be the guy showing up and saying, see, we're very smart that we underperform because you have half of your money sitting outside the United States, and currency can really crush it. Can do very well for you in the meantime. So I don't think you need a 50. If you're just purely talking an equity portfolio, I wouldn't do 50-50. But whatever your international exposure is, we have been underweight historically over the last 5, 6, 7, 8 years. And we're starting to probably get that to a more normalized fashion. So that's one of the big macro things we're thinking about, regardless of tariffs.
Sorry, John, can I add on to that?
Yeah, please.
So I would, for those of you who are not following this, and anybody that watches this later, a couple of weeks back, there was something called the Berlin Accord, where they're going to print a lot of money at the end of the day. You guys all remember the Eurozone crisis a decade or so ago. They put all these controls in place where countries would not spend a certain amount of money relative to their GDP, et cetera. They threw that out the window and labeled it something different so they can go print $1 trillion or 900 billion, whatever the number is, right?
Euros.
And certainly defense spending is a big deal. So there's a model for that, which is you can go look at Abenomics in Japan a couple of years ago, where they changed their constitution after 75 years coming from World War II, which we put in place in the United States, that allowed them to ramp up their defense spending relative to GDP. I think it was capped. I can't remember. It was like 0.5% or 1%. We're closer to like 4 or 5%. Germany's at like 2%. And so they're allowing them to ramp up their military to go up to X% of GDP. In Europe, they're going to go from 2% to 3 or 4%. And there's yardsticks for this, so everybody has an idea. Every time you increase your spending by that a number on a deficit to GDP ratio, your interest rate's going to go up 0.5% to 75 basis points. That's an adjustment. So in the German Bund, for example, if you believe they're going to put all that money together, you don't want to own a German Bund because it's going up 1.5%. So you want to look at your European fixed income allocation to make sure you have more U.S. Treasuries and less European global fixed income, because you're going to lose money on that. On the flip side, you want to get the investment right in Europe. Of course, you want defense spending because you just want to go out and buy whatever the equivalent of, the Northrop Grumman, Raytheon, Lockheed Martin, General Dynamics trade is, right? The problem is the multiplier effect in that space is not really that high. Whereas if they put half that money towards infrastructure, the multiplier effect on infrastructure is like 3 or 4 times as much as the defense spending in terms of creating dollars in the economy. So you want to blend that with, to Darren's point on the defense side, own some infrastructure or even some real estate in there, because that's a good investment based on the amount of, effectively they're just going to put 10 pounds of bologna in a 2-pound bag for the next 5 years, right? So you want to be a part of that. The other things I would just highlight in this, because there's so much more to this discussion, is you have to be very mindful of what your currency exposure looks like, your gold exposure, and your U.S. Treasury exposure, because there's a lot more domino effects of this if you believe in all these other discussions, like the Mar-a-Lago Accord that's being heavily talked about, right? We don't know where we're going. And so while it all sounds good, you want to be mindful of those. And then just one final point, I'll let you go back to you, John, is that this reminds me on a personal level when Japan decided to ramp up their fiscal spending with Abenomics, Prime Minister Abenomics. They called it the 3 arrows. One of those arrows was fiscal. If you use us as an example, we typically run a 2 to 3% deficit to GDP ratio. Currently, we're up at 7 or 8%, which has only happened several times in our lives during the pandemic, World War II, the GFC. Whatever Europe just did, they're doing the same thing. They're going from A to Z overnight on gargantuan size. You want to participate that. I will tell you, every discussion we're having, wrong or right, is what happened in Japan when we had to reallocate assets or asset allocation, which was, we're going to move money over there. How much? And the default answer at that time, 10 years ago, was we got to go put 15 to 20% of our portfolio there just in case. So it's not unrealistic to do that. And by the way, even if you put 20%, that's still underweight the All Country World Index, which is 30% international anyway. So there's too much in the US, too little over there. An argument that's like Abenomics, where you got to reallocate significant assets, there's going to be a 15 to 20% move in there. And heaven forbid they actually demonstrate that they can earn money. This is just off of fiscal support. Most of those companies are garbage in Europe. One day, if they ever show that they actually care about making money, distribute cash to us in the form of buybacks, if that's ever allowed, don't stand in the way of that move. Get involved in it.
Yeah. Let's talk about fixed income a little bit. So Nail, you run RTRE. It's an actively managed fixed income ETF. We use it in our models. I just think, like, with everything going on with rates, you've got to be more active in fixed income. I mean, it's one thing if you buy individual bonds. Like, I think, Darren, you do that for your investors. That makes sense. Like, you buy below par, wait for it to get to par. Obviously, you still take reinvestment risk, but when you run model portfolios like the way we do, Neil's firm, like you have to use open-ended
Yes.
funds. So we just think like it's crazy to think that you're just going to buy like an ag type ETF and not just actually pick and choose your credits, make duration bets. The analogy we tell our investors is like in equities, you got to get, your sector, your size, your style, US, non-US. Within that, it's okay, do you want value, dividends, small cap, quality, growth, momentum? Like there's like 10 different decisions you need to make to outperform in equities, whereas in bonds, usually it's like credit and rates, right? So it's like two decisions. Um, so Neil, maybe we'll start with you first. Like, what are you doing in RTRE? What sort of duration bets do you have on? How are you thinking about, rates? And then we'll turn it over to Darren.
Yeah. So just a qualifier up front on that, John. If none of you have moved money out of cash that has been left over for the last several years, you need to be doing that. So, everyone, I mean, you've all seen the same chart. There's record cash balances out there, in money market funds due to the interest rate hiking cycle over the last number of years. And not a lot of money of that went into longer maturities or, as John referenced, duration. And so there's a lot of money sitting between 0 and 2 years. In that instance, all of us as financial advisors run a very high risk of what they call reinvestment risk. I would just say that's at the, one of the highest points of the cycle. And I understand that rationale because fixed income has lost money for a lot of years in a row. It's been very challenging. And given our runaway deficit, I'm very open-minded to the idea that we could have a 5 or 6 or 7% interest rate on the 10-year. So I appreciate that risk. That said, I would just tell you the growth profile tells us we should have lower interest rates. The government, or sorry, the administration, Trump and Besant and are telling you we want to engineer interest rates to 3%. So if you're betting against
literally, they're telling us that.
Yeah,
literally,
they said those exact words. So
literally,
if you want to bet against that, that's up to you. Okay, but I'm not doing that. So the next question, then, I'm just on a layer down of managing risk. To your point, John, you can say the aggregate bond market, so the S&P 500 equivalent for fixed income beta, the AG, they run a duration or maturity profile of like 6.1 years, maybe 6.2. It's one thing if you decide to say I'm 5.1 or 7.1. That's your choice. But if you're sitting down at 2 or up at 10 and you're wrong by a huge margin. That's the equivalent of the S&P up 25 and you up 5. Clients don't typically fire you or remove you as an advisor for being negative when the markets are negative. But when the markets are up 25 and you're up 5, they get rid of you quickly because you've got to make money for them. And so I would say the same thing in fixed income. Decide where you want to be, but don't be too far off from where the bond market is at the moment. There's good arguments on both sides to be at it. Now, for us, we are right in line with that, and we are geared more towards U.S. government securities because we specialize in interest rates. We believe the neutral rate for or the equilibrium rate, meaning the level of interest rates where the economy is not running too hot or too cold, is somewhere around 2.25%. We have a white paper on our website regarding that. It's got a historical track record, believe it or not, of 100% accuracy on the data analysis of it. We're likely going to go back there at some point. In the meantime, for government work, it looks like there's a trajectory from 4.5% Fed funds down to 3%. And I think we're pricing right now, as of today, based on the tariff action, we've just injected about total of 1% of cuts for the year 2025, which is up from 0.5% just a couple of days ago. So if you're not on board with that, okay, we're going to go from 4.5 to 3.5. Can we go to 3? Yeah, sure. And then in the way this usually works is just think the 10-year typically is 50 to 55 basis points, maybe 50 to 75 above that. So the 10-year should get down to 3.5% if the Fed funds is going to 3%. And if Trump is right or Besant's right, and the 10-year goes to 3%, and you're sitting at a 2-year maturity, you've missed out on a lot of upside performance. But the real takeaway is you only get one try to get long fixed income when you're coming out of an interest rate hiking cycle. and that lasts for the first 18 months, and then you got a long time, another 6 years or so to benefit on the other way. So you don't want to miss that initial thrust, which is about a third of the entire move, and it's a lot of performance. So that's what we're doing. And then, like I said earlier, we've removed in the fund that you referenced, our standard total return fund, we've reduced exposure to high yield to zero. We've reduced exposure to emerging markets to zero. We just don't want to play the games, and so we've introduced that money into U.S. government securities. And then in our other fixed income funds, we run a dynamic fixed income fund that's much more active with a much higher distribution yield. In that one, we're probably overweighting, yes, more government, and we like municipals at these levels as well. Otherwise, we're not doing anything special this time around, John. We own some upside optionality, with defined risk profiles. If the Fed were to cut 50 basis points by July, and maybe we know that answer by June, which, hey, we might know that by Tuesday at this pace. So
yeah. When is the next Fed meeting is, what is it? April?
3 weeks. 3 weeks.
Yeah. I think if we sort of see this price action, be persistent, I think there's a good chance they do like an emergency cut.
Oh, okay. So let's
before you get into that, let me give Darren some opportunities. Just how are you managing the bond side for your clients and your advisors? You said you're the director of research. You have 80 advisors at your firm, $5 billion assets.
Yeah. So specifically on that, and as we started this whole conversation, it was, let's not pay attention to just what happened yesterday, right? So to Neil's point, we've been pounding the table because you just have people come in, 4%, 4.5% money market. This is wonderful. How great is this? Because it was at zero for so long. Why would I want to take longer risk? And we have been pounding the table going extend duration. And Neil, to your point, look, if you're at a zero duration, that's not going to be good because this thing is going to go down. They're cyclical. And we agree with you. The Fed funds is probably still at least a point too high, right? If you just look at kind of GDP growth prior to all this stuff, and if it's coming down, that means you should be cutting interest rates eventually. And so, coming down a point makes complete sense. So, I mean, the advisors that have listened to us and the clients that have agreed with us, we've got our bond duration are, they're individual bonds, and the overall duration is probably 6, 7, 8. And we own individual bonds. And, our whole thought was, look, if interest rates go up, you're going to have bonds coming due. We stick them out. That's fine. But given the fact that interest rates were actually at zero, and now you're looking at, 4.5, it just makes sense to extend duration. So we've been doing that. And same thing on emerging markets, high yield. I get people selling me that all the time. Our bond portfolio is for exactly like times like this, right? When the world's going crazy, do you have a piece of your portfolio that you can look at and go, oh my gosh, thank gosh that's there? And there's one of two reasons, right? Everybody tells you you're aggressive when the market's going up. I don't want to hear that. I want you to tell me you're aggressive when the market's down 30% and you look, or 40 or 50%, and you look at your bond portfolio and you say, can we sell all of that? Because if you're going to rotate, you need something that's going to be up. And to Neil's point, if you got gold, that's been working really, really well as well. So you have to have protection stuff. And to me, it's about instances like this. Otherwise, if you're 100% stocks, it's like getting in a fight and basically putting your hands down. You just got to get punched in the nose and not much you can do about it. So people with us, bonds are there for, hey, thank gosh we got it. Or, you know what, let's sell some of these bonds because now we're down and move on. But at 10% down, that's not enough for me. 10% is a normal move. Yeah, I'm with Neil, 20%, 25%. And if I had a 60-40 portfolio and I had somebody who's really aggressive and wanted to roll into equities, if we're down 25%, let's sell half the bonds, right? And then understanding this thing can go down another 25%. And if that happens, then you sell the whole thing. Now you're all in at equities. Hopefully the market's down 50% and it doesn't go down much more. So,
yeah, you guys keep talking about down 50% market. That's oof, that'd be really bad.
Yeah, I'm not in that camp.
I'm
Don't
not
put me
either,
there.
but I've lived through two of them, right? I mean, I remember. I mean, just think, and they were both different, right? 2000, 2001, and 2002. To me, was just the fact that the markets were crazy overvalued, and so down 50%, and then the Nasdaq was down 80, 90. What was 80?
80%? Yeah,
80%, right? And look, I knew people that I'd been talking to at the firm I was at. You cannot do this. They woke up one day. They thought they were diversified. They had 5 funds. They were all Janus funds. They all had the same stocks, and they were down 80%. And
yeah.
there's nothing you could do about it. So I've lived this.
We did
and
see
I
some
always
of that.
prepare for this.
Yeah, but Darren, we did see some of that the last 2 years, right? Like when Neil was sharing his screen at the very bottom, I noticed Apple. Neil's screen was saying Apple's down 9%. We have a lot of advisors and a lot of end clients that own, these individual stocks that, for years they were just kept on piling into them. So that's kind of what I opened up my call with by saying, like, we had a lot of late cycle behavior, whereas a ton of money going into levered ETFs, like 2x levered NVIDIA ETF garnered $8 billion in assets last year. So, there's going to have to be some pain. And, sometimes you need a bear market to kind of recalibrate risk and behavior.
You do, but I mean, as portfolio managers, if you've been working with your clients over time, the correct answer is, hey, congratulations, Apple doubled on you. Let's trim some. Hey, congratulations, Apple doubled again on you, or NVIDIA, or any of this stuff that's been, going through the roof over the last couple of years. As a responsible, I think we're money managers, right? Take some of those gains, put it in your pocket, move it to other stuff. And if your biggest problem in life is that a stock keeps doubling on you every year, and you go to your buddies and say, hey, I get the stock, I keep having to sell half of it because it doubles every year. You don't get a lot of sympathy from your buddies. You're probably going to have to end up paying for most of the drinks. And if you do that over time, then you're prepared for this. So the real answer is, what do you do now? Not a lot. Hopefully you've been talking and taking gains along the way, and hopefully this is the bottom, right? And maybe it is. But if this is the bottom, 6 months from now, 9 months from now, when the market's going up again, or whenever it does, because it will, you need to have those same conversations. Let's trim a little here, put some in your pocket, move on. And, those are the portfolios that, Neil, to your point, look, if the market's up 25 and you're only up 5, you get fired. But if you're up reasonable and you're rebalancing and you're talking your clients through the ups and downs and making reasonable decisions and not emotional, those are the portfolios that win. And it's worked for 25 years. I'm assuming it's going to work for the next 25.
Yeah. Let's start to wind down. So Neil, I think, emergency rate cut, likely. Well, I think the probability. So any given year, the recession probability should be 15% on average, because there always could be like an unknown, some type of attack, a war, whatever, right? So then I think, once these tariffs started really being like announced, I started saying, okay, recession probabilities, if they're normally 15%, maybe 20, that should be like 25. Now it feels like it's closer to like 35% probability. I just feel like, we have a long time between now and the Fed meeting, long time between now and the bank's earnings. I don't like the price action that I see. I think, if it weren't for tariffs, probably the Fed would have communicated rate cuts, just because the economy, I think, had been slowing in anticipation of this new policy. So it just feels like now, like that's like the thing that could save the market, like a 50 bip rate cut. The problem is that, they sent rates down just by virtue of announcing these tariffs. So, the whole playbook was that when Trump came into office, 10-year was what, 4.5, 4.75. And now there was a lot of room to cut in a recession. Well, rates have fallen like 100 bips, right? So what do you think, Neil, as a fixed income guy? You say you're a rate specialist. Talk to us about, like, do you think there could be a rate cut?
So I mean, just a quick background. We everything we do here is based on a probabilistic outcome model. We're almost like the way we think about fixed income, or the nucleus of fixed income being the U.S. interest rate or the Fed in the front end, is driven off of probabilities. It's like a sports book. If it gets to 80%, we want to sell it. If it's at 20%, we want to buy it, right? And we look for asymmetry in everything: 3-to-1 ratios, 5-to-1 payouts, things like that. The idea, I guess, if you put a gun to my head and say, Neil, throw your model out for a minute and speak qualitatively or subjectively, what's your opinion? My personal opinion, which is separate from how we run our funds or investments, is that I think it will take at least one, if not two, negative job prints to get the Fed to cut an interest rate. Now, here's why. Like I said earlier, before these tariff announcements, inflation, make it simple, is running at 3.5% versus its 2% mandate or target, right, on their dual mandate. The worst case scenario that was penciled in from every PhD at a bank said that, hey, we're going to get an extra 0.5% of inflation if the worst case scenario comes out. Well, all of those paid forecasters today are ramping that up to a 1% move, not a half. So we're going to be at 4.5% in the Fed's mind, or the street's mind here by this weekend, no question. Cutting the interest rate in that respect, with that backdrop, it would have to be an emergency situation. So to your point, John, if the extremism of the tariffs would qualify to them as an exogenous shock, similar to a pandemic, a nuclear war, whatever that might be, and it qualified it, sure, I can see them doing that. In the absence of it not qualifying as an exogenous shock, and they're waiting for something fundamental, I think they need to wait for a negative job print. I have no idea when that comes, but when it comes, it's going to signal something bad is happening in response to what already has been happening. So I think the emergency to me is more once we see the negative cut. And then again, by the way, there's additional layer in that, John, which is cutting on an intra-meeting basis is very different than telegraphing cutting at a meeting, quote unquote, at a meeting, that they're going to do that 50 basis point or 0.5% cut. So those all have very big differences or different ramifications to bond prices or markets. And then to your point about, will that act as a put option? Right now, I think what we're seeing is the bond market's willing to go from 2 to 2.5 cuts this year to 4 cuts very quickly, but they're not front loading it. They're sequencing out starting in June, July to the end of the year. Your point would start to get priced at the April, not the April one, but maybe the May one coming up, where it says let's cut in May. There's absolutely none of that in the market, and I could just look at the odds. If the odds are 15% chance that happens, then you have a 7-to-1, over under, if you will, on that. So we should see if that starts to change, and we watch that like a hawk. We watch the rate of change in that. If the May probability starts to change, well, then we are open-minded to them cutting sooner. But to get an emergency, man, I would think we have to see a negative print with the unemployment rate up a lot, if not 2. I've never seen that happen. But.
And the other key point you made there as well, it's the rate of change, right? That is, it's not the change, it's the rate of change would have to be significant. And remember what we've had 51 months of job growth. If we get a negative print on jobs, or in a lot of this stuff, even when we get GDP is going to be messy, because there's a high probability that a lot of people have brought in inventory ahead of, they're listening to the president like you are, John, and they've already brought a lot of their inventory in, right? So GDP is going to be messy, regardless. And so I think a lot of the data over the next couple months will be messy. And to Neil's point, you're going to have multiple prints to confirm that the information you're getting is consistent.
Got it. All right, guys. Well, thank you. We're going to start to wind down. Any last concluding thoughts? We have only a couple minutes left. Neil?
Yeah. I got one. I'm just going to force you to look at this one last time. This a new slide real quick. Let me know. You see this scatter plot in orange right here?
Yes.
I just want to point to where I think we are. So one of our sub-advisors, GST, their trademark is Regime Pilot. This is the strategy, or the sort of the spirit of what drives our long-short systematic equity strategy. The symbol RSEE, and what you see here is all we've done is take the VIX and S&P returns and scatter plotted them over a 30-year period, and then we break it up into 4 different regimes. And making life simple, if you just look at the volatility row, between 24 and 48 is what historically is considered a stressed market regime. And VIX, let's say VIX right now, real time is around 27, 28. We are definitely in that zone. And of course, we need to see it stick there. What I would say is that the market and our models are transitioning from a normal environment to a stressed environment. And what that means is we are going to potentially thematically go down like in 2022, but there will be opportunities along the way where short-term models can be activated, and you can trade 2 ways within that in that longer-term trend that is, down or short, if you will. And it feels that that's where we're at based on the VIX and in this regime mapping strategy. It's being amplified by what President Trump has announced. It's being corroborated by what I observed earlier with the S&P and the US dollar down, along with gold outperforming all 11 sectors. So to conclude, John and Darren, our working thesis here, despite us trying to be optimistic, is that we are migrating from a normal environment to a stressed environment, which happens about 18% of the time. You're going to be trading long and short. You need vehicles to do that.
Absolutely. I think they're going to kick us off automatically. Darren, 30 seconds.
I would say make sure you're talking to all your advisors and all your clients. People are concerned. I've got friends that I know would never have called me, hey, what the heck is going on? So just being able to walk, clients and advisors and friends through, hey, what's going on, I think is important, and have a level head. But this, I'm with you. This is going to be bumpy. This is,
so I'm just thinking about Neil say chaos theory is Trump's specialty. I'm sure that wasn't a political comment, but I would say be global, be diversified, own cash. I mean, there'll be opportunities to get into the market. So have some dry powder, own alts, and growth is slowing, but inflation is going to go up because tariffs are inflationary. So own real assets because we're going to go into stagflation. That's it. Thank you, Neil.
Thanks, everyone.
And Darren, very much. This is the longest session that we had, but Neil likes to talk. So
is that good or bad?
The next one will be April 11th. But thank you very, very much, Neil and Darren.
Neil,
thanks for having us, John. Nice to meet you, Darren.
Thanks, guys. Thank you.